Good morning, everybody. For those of you in other countries, maybe your afternoon. So thank you very much for joining us this morning for our next set of webinars. So for those of you who I haven't spoken to before, my name is Jonathan Wu. I'm the Chief Investment Specialist for Premium Asia Funds Management. And for those of you who I've met before, good to see you online. We've got quite a number of people online today, so let's jump straight in to markets. So effectively, one of the biggest challenges now that we're seeing US growth becoming quite weak, and probably quite a lot of data now coming out suggesting we may have gone into a recession. We know technically the United States hasn't defined what happened last year as a recession in of itself, but overall the economic data is still showing to be quite weak. In that situation, what you can see here is that when you compare the US household and the China household, you can see that the Chinese household is sitting on far higher levels of savings and far lower levels of debt. So the propensity to save obviously is definitely in China's hands, and they're definitely in a much stronger position to be able to go through into this next cycle. And at least for the time being, which I'll show you guys shortly, the fact that revenge spending is definitely very, very strong in the current environment. In terms of a recap, in terms of our manager, obviously our manager, as you all know, is Value Partners based in Hong Kong, and they currently manage around $6.5 billion US, of which around 5 billion is equities, 1 billion in fixed income, and the remainder across ETFs and multi-asset portfolios. They are a homegrown group. And most of you that have followed us for the last 20 years know very, very clearly that we're one of the most transparent fund managers. And the reason is because Value Partners is actually a Hong Kong listed entity and is the single and only listed asset management company in Hong Kong, with just under half the equity still owned by the management and founders. We're headquartered in Hong Kong, but we have very strong coverage right across the China and Asian region, with over 50 of our investment team based in Shanghai, Shenzhen, Kuala Lumpur, Singapore, and London, allowing us to complete the full breadth of research that is Asia. I've recently, as a financial advisor, have seen people put forward an argument saying that you don't need to be on the ground to be able to invest well in places like emerging markets. And I find that comment quite perplexing, because it's effectively saying that a team in Hong Kong can manage Australian equities very well, and that's frankly, impossible. And same with New Zealand equities. If a group that's based solely out of Australia never travels to Asia, never is on the ground understanding the market, the culture, and the nuances of that particular region, you're going to have issues in translating that into returns longer term, because you just simply don't get the insights. Because ultimately what we pride ourselves on is the fact that we do over 6,500 company visits a year, right? That is our on the ground coverage between our 50 investment professionals. And the fact that we can do that, and the fact that we can do this without being led by brokers, because we don't follow broker research. We're also not a macro top-down manager. We are a bottom-up manager. We're just simply trying to find the best ideas. We also call ourselves relative value, and one of the key characteristics of that is that there is not a single sector that we exclude in terms of our investment base. So there's some value managers that exclude technology, for example, solely because they're generally high growth companies. We don't exclude them because there is always a point in time through market cycles, which I'm going to give you a really strong example in a minute about Alibaba and how we've actually sort of traded in and out of our position over time. There are times when certain companies, as opposed to their peers, trade at very attractive levels, and we would get in at those levels when we see appropriate and get out when we think that there's the fundamentals and the valuation is not attractive. One of the key premises of our investor philosophy is that there is never a bad company. There's just a bad price that you pay for a company. Now, the way that we generate those ideas to remain consistent across portfolios is that we run what we call a high conviction approach. And the high conviction approach is effectively what you see here on screen. These are all the senior investment team members and the sectors that they lead. Now, in amongst them and underneath them are the analysts, and those analysts feed up those ideas. So if we use Renee Hung as the example here that you see here on the second from the bottom in the first section, you can see there that she is in charge of information technology on the hardware side. Now, Renee is actually also the portfolio manager for the Prim China Fund and the Prim Asia Fund day to day, but there are analysts underneath her that are feeding up information and stock ideas for the IT hardware sector. She has to come up with the 5 best ideas, and so on and so forth for all the other members of the senior team that you see up on screen. They have to come up with the 5 best ideas. Then Renee, taking her hat off as the sector leader for IT hardware and putting on her hat as the portfolio manager, she has to then go out and start at least making up 50% of the funds that she manages using the high conviction lists. Now, historically, since this program was implemented in around 2018, what we've seen is that the portfolios for the funds that we offer here in Australia and New Zealand generally will affect 60 to 70% of the portfolio comes from those high conviction lists. One of the other benefits of investing in Asia and then also via us is that because generally investors don't have a material allocation to Asia, Asia and China actually gives you very good diversification and from the perspective of correlation. So we've updated these figures, and what you can see here is that the correlation outside of between the two funds and emerging markets is that the correlation doesn't get higher than 0.45. Right, that's very, very low correlation. So if you're considering in a world that's now deglobalized, it's a tale of two cities. You know, effectively, you're going to go in the camp of developed, or what we call Western markets is no longer really developed and undeveloped, but you're talking about developed markets being Western markets, and then you've got Eastern markets. You're now going to have a stand in both camps in order to achieve that level of diversification you need for your clients' portfolios longer term. Now, when we then line that up, and at the end of the day, if you believe in the Asia story, you believe in the philosophy that we have, that we're a bottom-up manager, at the end of the day, you're just looking at the returns. And what you see is that our returns definitely stack up. Since inception, we have performed exceptionally well after fees. And in 2019, we actually cut our fees to remove performance fees and aggressively dropped the management fee by 45 basis points to a very attractive 1.33% all-in rate. And we have very much outperformed our key competitor, which is Platinum Asia. They're still the incumbent by fund size, but at the end of the day, we try to simplify things. We don't try to, make it rocket science. We don't do long short. We don't do active currency plays. All we're professing to do for your investors is effectively trying to find the best ideas and just buy in as a long only investor. So it means that when you need to explain to investors why there are periods of time where we underperform or periods of time where we outperform, you can very clearly explain to them why that's the case. We also have updated our figures with regards to where we sit in terms of our peer group. The peer group is growing, definitely for sure, which is good to see because having more participants in this space means that it keeps us on our feet. It also means that, it also means that there are more people interested in the asset class, and generally fund investors are more sticky than your retail mum and dad traders in that space. And what we're very proud of, again, is our track record. And in our peer group, which is the Morningstar peer group across the globe, we are a quartile 1 manager over every time period, and we've created very good excess returns across all time periods for investors net of fees. And at the end of the day, you're after net of fee performance for your investors. So moving on to the start of our investment updates, what you can see is that China is definitely into a new investment cycle and a new growth cycle. Because what we saw for the first quarter, China's GDP growth actually surprised on the upside at 4.5%, most of you would have seen. If we then consider where the data then has taken us through, is that the manufacturing PMIs are not particularly strong, but the services PMI is actually the strong part. And given the fact that China is transitioning to become more of a services and consumption-led country, when you compare that to someone like Australia, where we're at about 60–70% consumption, China is now at about 50% consumption. And what you see in terms of the contribution for GDP growth on an estimated basis based on Bloomberg consensus, you can see that for 2023 full year, it is expected China will hit about 530 basis points of growth, whereby the contribution for consumption is like 80% of that level of growth. Furthermore, what you see is that contributions from net exports for the forecasted 2 calendar years going forward is negative. Okay, so if you consider going back to our Economics 101 training, you'll recall that economic growth is effectively made up of consumption, government spending, investment, and net exports. Net exports has effectively now become a negative attributor towards growth. But retail sales is also a very clear driver for the following 2 calendar years in terms of growth. Now, the Chinese government has taken a 180-degree turn in terms of policy post the reopening of the economy in late 2022. And in the bottom left-hand corner is probably where I want you guys to focus on. And the 3 sort of turnaround policies is 1, boosting consumption, and that's more of a post-COVID world. Everyone can come back out, eat, drink, and be merry again. The right-hand side, the bottom right is the platform companies turnaround. So the government had a very aggressive approach towards platform companies in the early part of COVID. Again, this is not correlated to COVID. This was more based on government policy. And effectively, it started off with Ant Financial, being the subsidiary of Alibaba, which focuses on microfinancing and wealth management. If you recall, back in 2020, Ant Financial's IPO was effectively shelved and canned. And recently, the CBIRC, which is the equivalent of ASIC in Australia, has now allowed Alibaba to actually raise the capital base by issuing debt and also equity. The government is very much very supportive of this. And you may have seen that in the early part of April that Jack Ma suddenly reappeared back in China. And this definitely gave a very, very strong signal to private enterprise in China that the Chinese central government is very supportive of that, because Chinese private enterprise needs to sort of, in a way, step up and also be part of the ongoing sustainable growth story, not just relying on the government's investment in certain areas. The third part of that is the property market, and that's been, an area that has gone through what we call the Great Purge here internally, and now it's coming out of that. We're now going to the 3 arrows instead of the 3 red lines. And the 3 red lines, for those of you that don't recall, were effectively the very restrictive government policies that came through with regards to effectively not allowing property companies to be over leveraged. And we'll actually talk a lot more about the property sector in the fixed income update that will happen at 12:30 Australian Eastern Standard Time. So if you haven't registered for that, please join us for that. Check your email inboxes and register for that webinar as well. And I'll go into a little bit more detail, because that sector has also transformed the way that we're now assessing viability of companies, especially against the duration of those bonds, has been more critical than ever, but the lens has definitely changed. Retail sales, as you can see, or consumption overall, you can see on the right-hand side that we're now measuring the data against what we call pre-COVID levels. And what you can see is that against those pre-COVID levels, you can see that most areas outside of cinema visitation and passenger turnover is looking at effectively flying, is all over 100% of the 2019 level. So this proves to a certain extent that it's not about revenge spending alone. It is the resumption of normality in China. And the Chinese government is definitely very much pushing the consumption side and encouraging people on the consumption side. Even in Hong Kong, which I'll be traveling to next week, is for the first time in 3.5 years, is also, there's a lot of government stimulus going into the system where everyone that holds a Hong Kong ID card has gotten $5,000 of spending money to sort of boost that consumption and sort of get back to some normal spending patterns that we saw before COVID. Turning our attention now to China SOEs. Now, this is a very interesting topic that I want to spend a little bit of time on, because it also reflects a number of the holdings within the portfolios. So SOEs are state-owned enterprises, so government-owned entities or majority government-owned entities, and they make up a reasonable material part of the economy. as most people expect of the Chinese economy. Now, SOE reform and the reform of the SOE sector has been an ongoing process. And to be fair, it's been start-stop over many decades. And the last time we saw a large shift in mentality was in 2017, which was sort of dealing with the supply side of things. So in 2017, the government had put forward a proposal where effectively they were going to reform the SOEs by controlling the amount of supply, because a lot of the resource companies, including CNOC, a lot of the mining, coal producers in China, they're all SOEs. And in order to sort of maintain high levels of revenue, which was the key metric by the Chinese central government in terms of whether or not an SOE was performing, they were effectively kept pumping out coal, iron ore, so on and so forth, but there may not necessarily be at that point in the economic cycle end demand. And that's a problem for the government. So what they did was they did supply side reform, and then that sort of fell off a cliff. And then COVID hit, and then we all seem to forget about SOE reform. But now, given the fact that the Chinese government is now very cognizant of making SOEs perform relatively in line, objectively, with private enterprise, everyone should focus on the last bit of policy that was announced in February 2023, whereby instead of simply looking at two metrics being revenue and total profit, so gross revenue or total profit, which both of them can be reasonably manipulated on supply side and also non-cash items. They now basically put forward 5 other new key financial targets, which includes asset liability ratio, ROE, R&D intensity, labor productivity, and operating cash flow. So all of these now are much more in line with Western standards, if you can call it that, as well as the standards of private enterprise in terms of the way SOEs are performing. So how does that translate into portfolio holdings for us? So in the last 2 months, there's been 2 levels of trading that's been happening in the Chinese equity market, one of which is in AI. And I can categorically say that we have no exposure in AI, even though that sector's been outperforming very strongly. Why? Because they don't make any profit. Okay, AI is trading on just in a similar way. Our viewpoint is like trading crypto at this point in time, right? It's not profitable. There's not a lot of backing it, but there's a lot of hype backing it, and that's nice, but that's not good, and it's not a good risk for our investors to take on. The other part is SOE reform. And so a lot of SOE companies, we started positioning ourselves within our portfolio. So to give you a couple of examples at the moment, at the end of April, the Premium Asia Fund holds 18% in SOEs, and PCF holds 23%. These are quite high weightings compared to historical, and the reason for that is we're playing on this theme. It's about equal weight to the bench, and we're holding things like China Mobile, which pays a dividend yield of 7%. Like, that's quite incredible. China Telecom's about the same, pays a dividend yield around 7%. CNOC, which is the oil and gas diversified play in China, the largest of which, is trading a PE of 4 to 5 times and a 6% dividend yield. We also hold 2 groups, which is China Railway Construction and China Railway Group, both SOEs also trading at 3 to 4 times. The only part of the SOE sector that we're not heavily invested in is SOE banks, because we think that they have a number of headwinds, but we play private sector banks, which is not part of this theme. I'll talk about that a little bit later. But what you see is that we're very, very dynamic in the way that we're investing. And as a relative value manager, this is why our Premium China Fund portfolio specifically is trading on a P. The portfolio P is around 9 times. Okay, this is quite an incredible theme. We don't think it's going to play out relatively quickly. It's sort of a medium-term theme for us. But if the government is very cognizant and very steady-handed in the way that they're going to reform SOEs, it's going to be a good sector to get into. To look at that and translate that into valuations, the gray line, which is the MSCI China Index ex-tech, ex-US listed companies, which is generally tech, and A shares, that's what we call the old China shares, or the old China economy companies. And that's trading at a P currently of 6.4 times, right? This is why we're in that part of the sector at the moment, at about a quarter of the China fund and about a fifth of the Asia fund. But no matter how you want to look at it, whether or not you want to take the whole index, which includes tech, or take the XA share version of the index, they're all trading at quite below their 10-year average. But you will note that the gray part here that you see, that part in that most recent part of the trading cycle, because this data ends at the as at the end of April, you can see that there's been uptick in the P of the gray bar, but not an uptick in either of the other two. And that's because the SOE shares have been actually revising up on the P side, not on the E side. Taiwan at the moment, we're slightly underweight. We have still heavily invested in TSMC because we think that there's end of the bottoming out of the chip cycle. We think that we don't see a lot of downside risk. Quite a similar story for us in Korea, because in Korea we've actually recently increased exposure to Samsung, more than we had in the last sort of quarter to 6 months. And the reason for that is we think we're maybe a little bit early. And that's fine, but we may be a little bit early into the bottoming out of the chip cycle. On April the 6th, Samsung actually announced that they're cutting chip production, and that's actually more of a signal for us to show that things may have bottomed out, because they're seeing global demand actually shrink off given the more challenging economic environment that we're facing. If we then look at South Asia, we still think that that's going to be moderated in terms of inflows. We think that they're more susceptible to US recession and European recession. Yes, the Europeans managed to escape a recession because it was the hottest summer on record, which means the gas prices and gas shortages wasn't a huge issue for them. But overall, South Asia is not particularly attractive for us, and you'll see that later on in terms of our portfolios. India is also remaining quite challenging for us because solely on valuation, and as a relative value manager, that's a place that we haven't played a lot in because it's traditionally still very, very high on the valuation scale, which is just, a bit over 20 times. Sort of moving on to what I was mentioning before in terms of the private sector themes and where we're playing into the private sector banks. Our key player is the China Merchants Bank, because 16% of their revenue, which is the highest across any Chinese bank, their revenue base comes from wealth management. And what you see here is that China's total AUM by source, you can see that domestic is where this growth is quite phenomenal. So in 6 years, on actual numbers from 2015 to 2021, it more than doubled, okay, in USD dollar terms. So what you can see here is that it's all about domestic, right? It's not inbound foreign investors, but it's domestic. If you look at the external example as well, 5 years ago, globally, there was about 150 Chinese equity funds available in the market. As of now, there's about 260. So in a 5-year transition period, there's been so much more interest in the Chinese equities. I can only say that us as a business that started 20 years ago, that we were probably 10 years too early to the game. But given the fact that we've had the ability to generate our track record and prove to the market our strength, that's why in Australia and in New Zealand, we are running the largest Chinese equities business, and therefore you should have confidence with continual investment with us. With regards to Alibaba, let's have a little bit of a discussion on this, because I think this is quite an interesting topic. What you see here is I got our investment ops team to generate the share price of Alibaba versus our weight in both the China fund and the Asia fund. And why I want to talk about this is that Alibaba sort of post our national roadshows in New Zealand and Australia, and in the middle of March, we had quite a bit of announcement on the back of Alibaba, because Jack Ma reappeared in China, and Financial got clearance from regulators to raise capital, and then Alibaba announced that they're breaking up. So what was the breakup all about? So on the 27th of March, Jack Ma came out from hiding, and he also appeared at one of the schools that he built in Hangzhou. And then Alibaba then subsequently announced that they're breaking up each of their individual business units. Okay. One of the reasons why we think this is the case is because of the government's stance now that they're supportive of private enterprise. From Alibaba's perspective, we also think it's quite interesting. From a pure philosophical perspective, Alibaba runs about 6 different business units. If you actually dig deep into their P&L, only one makes money. significant money, which is e-commerce. Most of the other businesses make a loss and at best break even. So even their cloud business is actually is break even. Payments, fintech, local services is all loss making. A big business, which is the logistics arm called Choi Neil in Cantonese, that's also likely to be one of the first companies to probably go into a separate spin-off listing. And their international e-commerce platform, which is called Lazada in most Southeast Asian countries, are probably going to be the next cow off the rank. And what's interesting to come out of that as a story is that when you spin out of a large conglomerate, each individual business unit all of a sudden needs to stand on its own 2 feet, right? They can no longer rely on the parent to simply be, one part of a business that while your division loses money, the overall business makes lots of money because the other divisions are sort of covering you up. So one of the positives about spinning out the individual businesses is that they're all going to have to stand on their own feet, and it means they're going to have to adjust to market conditions faster than that they previously have when they were hiding within the broader Alibaba group. If we look at the sum of its parts, Alibaba is a very, very cheap company. Okay, so the e-commerce business unit on its own, based on our valuation model, is showing that it's trading on about 8 to 9 times P on FY23 earnings, right? Against a group level PE that's trading at about 12 times. Okay, both 23 and 24 financial year, the numbers look approximately the same for us on our valuation model. But the e-commerce platform, which is the one that makes the most money, is 8 to 9 times. But when you blend all the other loss-making businesses, the group PE level is about 12 times, which seems a little bit odd. And so prior to the restructure on the 27th of March, both the Prime Asia Fund and the Prime China Fund had about equal weight against benchmark for its holding Alibaba. But since the restructure, we've actually slightly increased our exposure, and it's based purely on valuation. So this is a really good example of, a live example of our sort of value bias in action, because we actually don't think Alibaba is a great business, but it's trading at a ridiculously low PE. So going back to that whole core philosophy of relative value, that's why we've increased our holdings. You can see here more specifically in March of 2023, which is a month ago, we were at about 5.7. And you may think, oh, the share price fell and went back up, and that's why we're now holding at 7.3. That's not possible because of our weights, right? The share price hasn't gone up. It's only gone up by about 10%. So even if you equally weight that, 5.7% multiplied by 1.1 is still not anywhere near 7.3%. So you can see that we've actually increased our holding going into that restructuring because of the simple fact, and same goes for the Asia Fund even more so, is because of the situation where we can see that the spinning out of companies will actually mean that people are going to see the true valuation of the e-commerce platform at cheaper than where it currently is trading at. So therefore, we're dynamically moving our position in Alibaba to reflect that. It's actually a very, very interesting, it's a moving beast for us at the moment, which granted, it does generate portfolio turnover for our portfolio, but again, that's something that investors have been very used to in our strategy. With regards to the performance of Prime Asia Fund, we sort of already delved into that. We've produced a very strong 9.8% after fee performance, which is very, very strong. And year to date, for the first 4 months of the year, we're already up 9.1%. So very, very healthy returns for our investors there. With regards to the geographical and sector exposure, you can see that we're still very much biased in that northern Asian space, and that the portfolio effectively holds no cash. We're fully invested because the valuations justify to be fully invested. There's so many opportunities for us to buy in this environment, especially when US equities are still quite expensive and Australia is slightly expensive. People are looking for ways to diversify portfolios to get into cheaper markets. And one of the ways to do that, as you can see on the valuations, whether you take tech or not take tech, or just look at the old economy stocks for China specifically, it is very, very attractive. So that's why that's reflected through our portfolio here. And when you consider the top holdings of the funds, for the Prime Asia Fund, for example, even with the blended non-China specific holdings, you can see the PE of the portfolio is around 10 times. Price to book is only about 1.3. And so you can see here that our active weight is 72%. So you can be always rest assured that our portfolio is always very, very active and looks nothing like the benchmark, which is also reflective of how we've been able to find those ideas, flow it through the portfolio, and generate the performance that we have over the last 13 years for the China fund and 18 years for the China fund. With regards to China fund, since inception, and this is going all the way back to 2005, we've produced 7.2% net of fees performance for investors. That's with, obviously high levels of volatility because of the fact that, we had to go through GFC. And so therefore, yep, it's been an up and down journey, but investors have been generally very constructive around the total performance of the fund since inception. And what you can see here in terms of our geographical and sector exposure here, you can see that there is no Taiwan or very little Taiwan in the portfolio, but we're very much in both portfolios quite heavily invested into consumers. And that's because that spending, we think that there's a part of it that's revenge at the moment. We think a lot of that's priced into the market. But then on the other hand, we also see that there's a structural consumption strategy that the Chinese central government is pushing to ensure that the Chinese consumer sustainably, because all of it, remember, when the psychology of your populace changes to consume more, it needs a period of time to transition. COVID obviously put a bit of a dampener in that, but now the Chinese government is very much concentrated on this to change the psyche, reduce the savings rate of the Chinese population, increase consumption, and therefore creates more internal stability and sustainable growth at somewhere between 4 to 6% long term. If anyone thinks that the Chinese government can produce more than 4 to 6% in an economy that's already now the second largest in the world, that's simply impossible. And if you look at the top 10 holdings and the metrics of the fund, you see the PE of this portfolio is 9 times. That's it, with the price to book of 1.2, dividend yield of 3.4. Active weight on this is just under or 2/3 of the portfolio. So you can see we're quite heavy in tech, retailing, and also consumption here. And you can see that now you'll start to see companies like China Railway Group, CNOC, which is now creeping up in terms of those state-owned enterprises flowing through to our top 10 of our portfolio. So I've gone over by 2 minutes, and I apologize for that. You'll get a copy of these slides after this presentation. And please feel free to reach out to us. You see our details on there, both me and Derek for Australia, Clayton for our New Zealand partners, and all our contact details are there. Please feel free to also tune in. We've put up a number of short videos that I've done with Gordon and Frank when they were in Australia, post our roadshows, and we did it in sort of small snippets, talking about consumption, talking about the Credit Suisse collapse and how we benefited from that in buying Thai Bank AT1s in the late part of March. All those are great videos for you to also share with clients as you're talking through with them about the broader theme and also about our funds, because we talk about both sides. We talk generically about economies and sort of where the strength points are, and we also talk about recent trades and themes within our portfolios. So with that, for those of you that are interested in the fixed income emerging market debt update, that's going to be at 12:30 Australian Eastern Standard Time. But otherwise, I wish everyone a great rest of the week. Cheers.